The ISM, the business cycle, is the driver of speculation, risk, excess capital, all of that stuff, because people have higher earnings. We're not positive yet. So although tech stocks have done well, stock markets have done decently well, Main Street has not. Businesses are still struggling.
Yeah.
But once that turns, and I think the Federal Reserve will be cutting rates because, as we've been saying for a long time, Julie and I, inflation is coming lower, and it is. Then we will see Main Street or people with mortgages, household income increasing, and that pushes people out the risk curve, and that's what drives the real cycle, particularly the alt season. So the alt season we find is highly correlated with ISM. Reality is everybody's hopes and dreams are in this trade, and so it sucks people in too late. Obviously, it always does, and it's a problem. But it's a feature, and the indicators you built before actually really help understand where are you in the FOMO cycle, because it's basically those indicators put together are basically FOMO.
So you're looking at Q2 now. It's kind of like where you've arrived at, where you think
not 100%, but we're kind of erring that way. I mean, definitely Q1, but it's looking like it might run all the way through till, end of H2.
Raoul Pal, CEO of Real Vision, believes that current cryptocurrency market trajectory closely resembles the powerful 2017 bull market, but cautions that this cycle could develop more slowly, possibly extending into the second quarter of 2026. Paul described the current market structure as 2017-like, suggesting a steady rise for Bitcoin with a likely long-term peak. Mr. Paul noted that while the structure may look familiar, the pace is different, largely due to macroeconomic headwinds. His business cycle score, a proprietary model that tracks the global economic situation, is still below 50, indicating that the market is in a recovery phase, but far from a full economic acceleration. Mr. Paul cited Bitcoin's performance in 2017 as a historical benchmark. The asset rose from $1,044 in January to over $14,000 in December, an increase of 1,255%. While Mr. Paul anticipates similar long-term gains in this cycle, he said the weak economy and falling U.S. dollar are slowing momentum. With the dollar's continued decline, there is every reason to believe this trend could continue into the second quarter of 2026. The U.S. dollar index, DXY, is down nearly 9% year-to-date, falling to 98.77, making Bitcoin a more attractive hedge. Historically, Bitcoin has an inverse correlation with the dollar. When the dollar weakens, demand for cryptocurrencies tends to increase. Paul argued that macroeconomic lags, including late interest rate adjustments and a stagnant dollar, have delayed the cryptocurrency cycle. According to Raoul Pal, the market is ready for the biggest altcoin season. Before we move forward, if you want to stay updated with the latest crypto events and news, you can subscribe to our channel and like this video. Now let's get back to Raoul Pal's view on Solana and the overall crypto market.
From my work, as you know, we just think for us it's kind of straight up from here. I don't know where Bitcoin gets to by kind of August, but we got a decent run. I think we'll be surprised to the upside in how fast stuff runs. Then we'll cool off for a bit, but even using Global N2 as a forward indicator, it barely went sideways for a period of time. So that feels like some chop in late summer. And now Global N2 is rising again, and it's got extremely good correlation. Now, it won't be perfect all the way, but it just feels to me that, from here on in, basically, we've got a really good run. And structurally going through your very detailed data-driven approach is telling me the same thing. It's kind of adding to my conviction that, we're about ready.
A weaker dollar typically coincides with an easing of monetary policy or a shift away from hoarding, which could free up capital to flow into other markets. Although controversial, Bitcoin and other cryptocurrencies are often viewed as potential hedges against the devaluation of fiat currencies like the dollar. A weaker dollar can reinforce this narrative. For international investors who hold other currencies, a weaker dollar makes buying dollar-denominated assets, such as many major cryptocurrencies that trade with dollar pairs, relatively cheaper. Paul's analysis suggests that focusing solely on the halving may be too narrow a view in the current macroeconomic environment. The combination of a weak business cycle and dollar weakness offers a different angle, suggesting that the post-halving rally could be more protracted this time around. This doesn't invalidate the significance of the halving, but it does suggest that external macroeconomic factors are playing an unusually dominant role in the length of this particular cryptocurrency market cycle. This perspective suggests that opportunities within the cryptocurrency market cycle may not expire as quickly as some models predict. However, it also highlights the importance of understanding the macroeconomic forces at play and approaching the market with a long-term perspective and a sound risk management strategy. Whether this prediction will accurately materialize remains to be seen, but it certainly provides a thought-provoking framework for the potential duration and dynamics of the current market phase. Cryptocurrency analyst Colin also highlighted the gap between the Bitcoin price and the global M2 money supply, which raised concerns that the bullish trend may be over. The analyst quickly responded to these concerns, emphasizing that such deviations typically occur at some point, but they do not invalidate the macroeconomic trend. Colin revealed that the Bitcoin price has deviated from the global M2 money supply. He emphasized that this gap was short-lived amid an otherwise highly correlated environment. The analyst added that this current gap is similar to Bitcoin's position in February 2025. Colin noted that this development does not mean that M2 is broken, just as it was not broken in February. Rather, he argued that this simply means that market participants have not taken enough time to account for periods of non-correlation. The analyst added that the non-correlation between the Bitcoin price and the global M2 money supply occurs 20% of the time. He then referred to the usual chart, which shows the strong correlation between the Bitcoin price and the global M2 money supply. Colin explained that M2 is predictive of the direction of Bitcoin and is not one-to-one related to the price. The analyst also noted that M2 does not predict a specific Bitcoin price. In fact, the overall M2 money supply only predicts the market direction with an accuracy of around 80%. Colin added that the Bitcoin price has its own y-axis while M2 is on a different axis. He also opined that M2 could decouple from Bitcoin as the cycle peak approaches. Although the analyst did not provide a timeline for this peak, his analysis indicates that it has not yet been reached and that the uptrend is not over. Paul also suggested that the correlation between Bitcoin price and money supply shows that there is no need to worry about the current price action. He noted that if 89% of Bitcoin's price action is explained by overall liquidity, then by definition, almost all news and narratives are noise. This suggests that current geopolitical risks exacerbated by the Israeli-Iranian conflict are unlikely to have as much impact on Bitcoin's price as expected. Trading firm QCP Capital recently noted that the flagship cryptocurrency has yet to experience widespread panic, a testament to the asset's maturity. The firm noted that Bitcoin's price resilience appears to be supported by continued institutional accumulation, with firms such as Strategist and Metaplanet buying on dips. Bitcoin ETFs also continued to see positive inflows.